How you doing on Big D? Welcome to the show. I do appreciate you spending a few minutes of your time with me today. But what I'm about to say could be the most important financial warning you could hear this entire decade. I say this because I'm not trying to sell you anything. I am not a professional when it comes to this. I'm not going to give you go out and do this, otherwise you're going to fail. But it's going to come across like that. I have a disclaimer in the description below. Please read it. I am not trying to push you into doing something that you shouldn't do without you doing your own due diligence and finding out what's going to be the best for you and your family. But silver just ran from $40 an ounce to $120 an ounce, and that was in less than a year. Gold consolidated above 5,000. Now, these are not random numbers on a screen. These are distress signals being fired from the financial system itself. And the terrifying part is the 95% of the people watching this video right now have done absolutely nothing to protect themselves. Nothing. You are sitting there watching prices explode, watching the dollars lose its purchasing power day after day, and you are still holding the cash like it's going to save you. Cash is not good. People talk about cash is trash. That's how you probably should look at it. The actual purchasing power of the US dollar is worth at least 97% less than when the dollar was introduced into this country. And if you're still holding cash like it's going to save you, I have been saying this for multiple years. Use the cash to get into some type of asset. And the numbers are now screaming it louder than ever before. The game has changed. The silver shift is not a blip. It's a structural, permanent, game-changing realignment of the global wealth. And if you're not positioned correctly right now, you are going to get absolutely destroyed. This is not a drill. This is not prediction. This is already happening. And you need to wake up before it's too late. I don't care about your feelings. I care about you and your money. And right now, the advice you're about to receive on this channel is kind of a guidance that wealthy people pay financial advisors thousands of dollars a year to access. It is the same caliber of thinking from a professor of applied economics, former advisors to the president, and institutional investors who have been watching these macro cycles for years and for decades even. You're getting it here. The only thing I ask is that you hit the subscribe button, smash the like button, maybe share this out if this is something that is interesting to you. Don't think about it. Just go ahead and help me out. I would appreciate it. People are hesitant, are always the ones who lose. Let me tell you what it really is going on in the financial system because most of you have absolutely no idea how broken and corrupted the economic machinery is. And I'm not saying this to scare you for the sake of drama or clickbaiting. I am saying this because the numbers don't lie. And when you look at the numbers clearly without a fog of political spin and mainstream media noise, deep state media, they keep you blinded. What you see is a system that has systematically abandoned every responsible principle of monetary management that once made economies grow and thrive. Here's what you need to understand. Decades ago, central banks operated under something called the quantity theory of money. It is not complicated. It simply means that There is a direct measurable link between how much money a government prints and what happens to inflation and real economic growth. Now, Paul Volcker understood this when inflation was raging in the 1970s. Volcker used this principle to strangle inflation by controlling money supply growth. It was painful. Interest rates went sky high, but it worked. It worked because the theory was correct. The numbers don't lie. If you grow the money supply at approximately 6% per year, what serious economists call the golden growth rate, you hit roughly 2% inflation and you generate real sustainable growth, economic growth. Now, that is the math, and this is the formula. It is not rocket science. But here's what every major central bank in the world has done since then. They threw that playbook in the trash. The Federal Reserve abandoned it. The Bank of England abandoned it. European Central Bank, the Bank of Canada, every single one of them looked at the proven mathematically grounded connections between money supply and inflation and decided they knew better. I don't think they knew better. They know they didn't know better. I think it was on purpose. There's multiple reasons for that. But let's get back to the story. And what happened? Inflation gutted your purchasing power. Asset prices went parabolic. And the people who held cash, the people who trusted the system, got financially slaughtered. And it gets worse because it is not just monetary policy that has gone off the rails. It is the entire orientation of the government towards markets. I am a free market capitalist. I believe that free markets, free trade, and individual finance freedom create more prosperity than any government program ever designed. What made economies explode with growth in 1980s was not government intervention. It was the opposite. Reagan, the Reagan deregulated, Thatcher privatized, Deng Xiaoping opened China in 1997 and triggered the single largest economic liberalization in the history of the world, lifting hundreds of millions of people out of poverty and increasing total factor productivity by 15 to 20%. That is what economic freedom does. That is what getting the government out of the way actually means. What are we getting today? We are getting the exact opposite. Every single day, there's a new sanction on somebody, new tariffs on somebody, new regulations, new interventions. The lobbyist industry in Washington, D.C. is the hottest business in America right now. And do you know why? Because every corporation, every industry, every business owner has to pay someone to go and beg the government not to destroy them with the next policy decision. This is not capitalism. This is cronyism. That is a system designed to funnel money towards the politically connected and away from you. They want you poor at all possible ways. And while all of this is happening, while the system is rotting into the inside, from the inside, the price of silver and gold is telling you the truth that your government and your bank will never tell you directly. Now let's talk about silver, because silver's move is the game-changing shift that this video is about. And you need to understand exactly what happened, what it means, and why the people who panicked and sold are going to regret it for the rest of their financial lives. They saw it hit $120 plus a short time ago. What, 4 weeks ago? It's pulled back a little bit, but it's still, we're way ahead of what we were June of 2025. Way ahead. It was only $30 an ounce. This today, before coming on, I think it was right around $78 an ounce. It's mind blowing what people consider a loss, and they are freaking out. And they thought it was going to drop, and they didn't want to lose. So silver went from $40 an ounce and ran all the way up to approximately $120 an ounce. This is a tripling of price. Tripling. What happens next is exactly what always happens at a massive bull market. And if you look at it right now, you are still probably, well, if you bought it at, 18 to 25 bucks, maybe 30 bucks like back in June, you're almost 3 times higher than what you paid for it. So why would you sell? Did you really consider it to go back to 25 bucks, 30 bucks? That's crazy. You have to look at what's going on. The market, the silver market has had a deficit every year for several years, at least 500 million ounces behind of what we're actually using. Several years. The demand is through the roof. China has stopped selling to the West. There's just so many details that tells you there's a problem with silver. And silver is being smashed down by something. Well, you look at paper silver and derivatives, that's your problem. Now this happens to a massive bull market and it pulls back. It's corrected. And right now, silver consolidating somewhere around 75 to 80 bucks an ounce. And every weekend, investors who bought it $100 or $110 and sold at 80 is sitting there right now telling themselves they got burned. They got tricked. The market is rigged. You are broken. And you don't even know why. But here's the truth. Corrections and consolidations and bull markets are not the end of the rally. They are the fuel for the next leg up. What a correction does is it shakes out the weak, emotional, undisciplined investors who bought based on hype and have no real understanding of why they own what they own. When those people sell, the asset transfers from the weak hands into the strong hands and into the hands of the people who understand the macro thesis, into the hands of people who know that silver at $80 even, after pulling back from 120, is still it's massively above the 200-day moving average. It is just mind-blowing to me that people would sell. Now the trend is still intact. The structural reasoning to own silver has not changed. Not one of them. Think about what drives silver. It is not just a precious metal. It is not industrial metal, solar panels, medical equipment alone. It creating a supply deficit that has been building for years. Add that to the monetary demand, people fleeing fiat currency, seeking real tangible stores of value. Now, the BRICS nations, there's multiple countries, 34, I believe, they just came out with this little news report that are no longer using the American dollar. De-dollarization is here and it is here to stay. It is going to change many things, and silver and gold are going to increase. Another reason why it's going to increase. Now you have a demand profile that no correction can erase. And now people are even earning a yield on gold paid in physical ounces through innovative platforms, accumulating more metals simply by holding it. The game has changed, the rules have changed, and those who understand these new rules are going to accumulate extraordinary wealth, while everyone else argues about whether silver is in a bubble. The narrative has that caused the pullback was the nomination of Kevin Walsh as the new Federal Reserve Chair. Supposedly, he's a monetary hawk who would tighten policies and crush precious metals. But here it is. What the serious thinkers understood while the herd was panicking and selling. Now, Walsh, who has not even been confirmed yet, Nobody actually knows his real policy intentions except for his past and what he's done in the past. But those were different types of economies. Everybody's freaking out. But why? Now, the narrative was built on speculation, layered on top of speculations, and the market is used it as an excuse to shake out the weak hands and transfer wealth from the impatient to the patient. I hope you're one of them that went out and bought more silver, even some gold. I know gold is considerably more, but do you need it in your portfolio? Physical silver, physical gold. I believe you do. So stop being a victim of narratives. Stop being a student of mathematics and macro. The numbers don't lie, and the numbers say silver's structural bull market is not over. Now let us move to the gold, because gold and silver do not exist in isolation. They move together. They reinforce each other. And what gold is telling you right now is critically important for your financial future. Gold has been consolidating around the $5,000 an ounce after an extraordinary bull run that saw it surge well past the figure before pulling back. And just like silver, gold remains dramatically above the 200-day moving average. Now, even after the pullback, let that sink in. Even after a serious correction, gold is still trading at levels that confirm the long-term uptrend is completely intact. Now, here's where I want you to pay very close attention, because this is where the math comes in. And I told you, a deal is cold, hard numbers, not feelings. If you are watching this video and you do not own any gold, or making one of the most dangerous financial mistakes of your lifetime, same thing with silver. Here's the specific guidelines that matter. A modest conservative starting position in gold is 5% of your total investable income. That's what they say. If you can do more, it's going to make it to your family is going to be secured if something happens. I shouldn't say if. I do believe 100% something is going to happen with the stock market and what's going on with the U.S. dollar. Is that dollar still going to be here? Are we going to turn into Venezuela? There's a lot of questions out there about that, but it looks very, very close. Now, that is the minimum. This is the floor, I believe. So are you going to be more aggressive, and are you going to understand the macro environment we're living in? The money printing, the debt explosion, the geopolitical instability, the abandonment of sound monetary principles? Then a 10% in gold is entirely justified and mathematically defensible. This is not speculation. This is a portfolio insurance against a system that has demonstrated repeatedly and clearly that cannot manage itself responsibly. Think about what has happened to the investor's portfolio over the last 4 years. Equity markets went on an extraordinary bull run. Stock prices surge, and what that means in practical mathematical terms is that the balance you had in your portfolio between stocks, bonds, commodities, and real assets has been completely distorted. So if you started with 60% equities 4 years ago, you might now be sitting on 75 to 100 percent equities without having made a single deliberate decision to increase your stock exposure. The bull market did it for you. And that means you risk exposure has exploded without your permission, without your awareness, and without any compensating hedge in place to protect you if equities correct sharply. Rebalancing your portfolio is not an option. It is not something you think about someday. It is a mathematical necessity right now. Trim your equities exposure. Use those proceeds to establish an increase in your position in gold. And for those who have been watching gold but hesitating because the price feels high, understanding that in a world where every central bank has abandoned sound money, where debt at the national level is at historical highs and the quantity theory of money has been thrown in the trash. Here is no responsible argument. There is no responsible argument for holding zero gold. The people who keep waiting for gold to come back to $2,000 or $3,000 are the same people who kept waiting for it to come back to the $1,000 range. They are still waiting. They will always be waiting, and their cash is being silently and ruthlessly inflated away while they wait. Let us talk about the thing that is making wealthy people very nervous right now. The thing that mainstream financial media is not discussing with the seriousness it deserves. There's a stock market bubble, not a maybe bubble, not a possible bubble, a definite, real, confirmed stock market bubble, particularly centered around the artificial intelligence sector and the same technology companies that have written the AI narrative to stratospheric valuations. And the mathematics of what happened when this bubble pops should terrify every investor who has not positioned themselves defensively. Here is what is driving the AI bubble. Hundreds of billions of dollars of capital have flooded into AI startups. Infrastructure companies, data center builders, chip manufacturers, all based on projections of future earnings that act have not materialized and may not materialize for years, if ever. These startup ecosystems in raising capital at levels that defy rational valuations. Individual AI startups with no earnings, no free cash flow, and no proven business model are raising $250 million funding rounds. That is not investment. That is particular speculation dressed up in the language of revolution. The history tells us without exception that when speculative capital floods an emerging technology sector at the scale, the majority of those bets go to the zero. Now you might be thinking, well, the big companies, the Metas, the Googles, the Microsofts of the world, they are not going anywhere. And you are partially right. There will be winners there, always. Our few dominant players will emerge from the AI era, just as a few dominant players emerged from the internet era. But remember what happens when, well, between 1990 and let's say 1999 and 2002, companies that were generally transformative, generally genuinely important, generally real businesses such as Amazon, Cisco, Intel, they lost 80 to 90% of their market value during the dot-com crash. The technology was real. The future was real, but the valuations were insane. In the market correction, it corrected them both brutally and without mercy. The only reliable mechanism that historically defies asset bubbles quickly and decisively is monetary tightening. When central banks raise interest rates and constrict money supply growth, the speculative capital that fueled the bubble evaporates and prices collapse. Now here's the dangerous part of our current situation. Monetary tightening does not appear to be on the immediate horizon in the United States, particularly under the current political environment. That means the bubble may not pop through the transitional mechanism, but it will pop. Bubbles always pop. And when it pops through some other mechanism, a credit event, geopolitical shock, a cascade of startup failures destroying investor confidence, it will be sudden. It will be brutal. And the people who are 80% invested in equities with no hard asset hedge will have no time to react. You are broke and you don't even know it because the number in your brokerage account has not crashed yet, but the conditions for the crash are already in place. Stop being a victim of the system. Stop pretending that because the number of your screen is higher today than it was 2 years ago, you're financially safe and financially intelligent. You are not safe. You are exposed and completely vulnerable to a correction that serious economists and investors are already warning about openly and urgently. Your portfolio is not a reflection of your wealth. It is a reflection of how much the money supply has been inflated. The numbers don't lie. I'm going to give you the specific mathematical, actionable solution because I do not just come here to tell you that you're in danger. I want to come here to tell you what you can do about it. And because this is a difference between teaching and critic. Um, Deal solutions, not just diagnosis. Listen to me very carefully and following in this framework that will protect and grow your wealth in the environment we are actually living in, not the environment the mainstream financial media is telling us, pretending we are living in. Step one is the immediate audit your current portfolio allocation. Pull up your brokerage account right now, today, and not next week, not next month, and calculate what percentages of your investable asset is sitting in equities. If that number is above 60%, you are overexposed and you need to rebalance immediately. Again, do your own due diligence. Make sure you're doing what's right for you and your family. But this is what I believe, and this is what I've done. This is not a philosophical debate. Um, Over concentration is a single asset class is how ordinary investors get wiped out during correction. And the correction that is coming in equities will not be gentle. Step two is to establish your gold position. If you do not have one, or if you don't have a position, then increase it. Increase it to at least five, but well, 5 to 10%. My belief. The mathematics of portfolio construction support a 5% to 10% allocation to gold as a hard asset hedge against monetary debasement, geopolitical risk, and the systematic financial instability. If your total investable portfolio is $100,000, that means $5,000 to $10,000 goes to gold, to physical gold, not paper. Stay away from the paper. Don't even come anywhere near paper or gold-backed instruments. If your portfolio is 500,000, that means 25 to $50,000 in gold. Run the math for your own situation and then execute. Not tomorrow. I would do it today. Step three is to understand the new tools available for earning a yield on your precious metal holding. The idea of simply holding gold and silver and waiting passively for price appreciation is now outdated. There are platforms that allow gold ownership to earn up to 4% per year in physical gold, not in fiat currency, not in paper promises, but an actual additional ounces of gold credited to your account. Think about that means mathematically. If you hold 100 ounce of gold and earn 4% annual gold yield, you accumulate 4 additional physical ounces every year without selling a single ounce. You are growing your hard asset base in real terms, while the rest of the world inflates their paper currency away. That is how sophisticated investors think. Now, this is the difference between the winners and the losers. Step four is to ruthlessly eliminate your exposure to the speculative zero earnings narrative driven investments. If you own shares in AI startups, space, or any company that cannot clearly articulate a path to positive free cash flow in the near term, you need to seriously reconsider that position. I am not saying all technology is bad. I am saying that Paying 200 times revenue for a company that has never turned a profit because someone told you AI is going to change everything is not investing. It is a gamble, and gamblers lose more than not. Winners invest based on fundamentals, cash flows, mathematical valuations. Losers invest based on stories, hype, and the fear of missing out. Step five is to understand monetarism and applying its principles to the own to own financial decision making, even if the central banks has abandoned it. If the golden growth rate for a healthy economy and M2 money supply growing at an approximately 6% per year, and the central bank has been growing money supply at two, three, even four times the rate of an extended period, you already know the mathematical outcome. Inflation, currency debasement, the destruction of purchasing power for everyone holding cash, fixing income instruments. Your savings account is not saving you. It is slowly killing your financial future. While the bank pays you 1%, 2% in interest and inflates your purchasing power away at 4%, 5%, 6% a year, the numbers don't lie. Cash is trash. Act accordingly. Now, I want you to leave with something that goes beyond charts and percentages and portfolios, allocations, because the truth is the biggest financial problem most people have, and not a lack of information, it's a lack of discipline, a lack of courage, and the fundamental unwillingness to accept personal responsibility for their financial outcome. Stop being a victim. The system is broke. I know it. You know it. Every serious economist knows it. But a broken system does not have a break, or doesn't have to break you. The people who understood what has happened in the 1970s and bought gold and silver and survived and prosper, the people who understood what has happened in 2008 and shorted bank mortgage rates, backed securities, became legends. The people who are paying attention right now, who are listening to the macro signal that silver and gold are sending, who are rebalancing their portfolios and establishing hard asset positions while the majority of the population sleeps or ignores. Those people are going to look back at this moment as the turning point in the financial lives. I don't care about your feelings. I care about you, and I care about your families, and I care about your money. And right now, the most important financial decision you can make is to choose which side of the history you are going to stand on. Are you going to be the person who understood that silver's move from $40 to $120 was structural signal positioning accordingly, earning a yield on physical gold, rebalancing away from the overvalued equities, protected their purchasing power through the coming storm? Or are you going to be the person who watched it all happen, who heard the warnings, who had access to the same information and did absolutely nothing because it felt too complicated, too scary, too inconvenient? There are winners and there are losers in every financial cycle. Winners are not born, they are made through discipline, education, decisive action at the right moment. Losers are not victims of bad luck. They are victims of inaction, denial, and the false comfort of thinking that because nothing has gone terribly wrong yet, nothing will. The numbers don't lie. The signals are clear. Silver has spoken. Gold has spoken. The macro environment has spoken. The only question left is whether you're going to listen. So I am asking you directly right now, looking you straight in the eye through this screen, are you going to be a winner or are you going to be a loser? The choice is yours. Make it wisely. Make it now. Don't wait. And if you're ready to keep getting this level of financial intelligence, subscribe. I do appreciate it, and please smash the like button. Share this with your friends. Share the video with someone who needs to hear this. I believe anybody can understand what I'm saying. Look at me. I don't look like I have huge knowledge. I just do a ton of research, and that leads my life. And I believe I have taken care of my family in every way possible. I don't have a ton of money, but I've found a way to make it happen. I think you can too. I want to say God bless. God bless you and your family. And I hope that going forward, you take what I've given you, do your own due diligence, and figure this out and get it done. Talk to a financial advisor, see what they say. I think they're going to say the same thing. Try to have a great rest of your day. God bless. And I'll see you on the next one.